My Prashant had caught up with Mahesh Nandurkar of Jefferies from the sidelines of Jefferies' second India Forum 2023. He started by asking his view on how one should play the consumption space going forward. Listen in.
So the way to play the consumption story, according to me, is through the staples segment, and obviously there are some financial companies as well that are leveraged to retail consumption.
I mean, again, broadly, the QSR space perhaps will fall in that category. I think you have a couple of QSR companies presenting. Devyani, I think, is presenting at your conference. Do you like that space as well?
I think the QSR as a space, once again, looks pretty attractive from a medium-term or a long-term perspective as well. But I just feel that maybe that space as a whole will probably still need to go through a period of 1 or 2 quarters where the investor expectations versus the actual delivery get mitigated. So I would rather wait for a couple of quarters before jumping into the QSR space here.
Got that. Again, on the consumer side, the real estate demand is held up remarkably strong, right? I mean, over the last 1.5 years, even as interest rates have gone up sharply. Do you expect that to hold, this sales levels across real estate companies to hold at current levels into 24 and beyond as well? And what are the investment implications then?
Oh, absolutely, Prashant. In fact, this has been our single biggest high conviction idea. And we have been talking about it for last couple of years, pretty much from the bottom. And while our thesis has played out beautifully even in the last 12 months in terms of the physical property market, doing quite well with the pre-sales numbers surprising on the positive side, despite the mortgage rates going up. But the stocks by themselves did not really do that well until recently. There is a lot more upside for the fundamental performance as well. I think we are in a real estate upcycle. Make no mistake about that. We are only in the 3rd year of real estate upcycle, and I think it's a cycle that should ideally unfold over the next at least 3 to 4 years.
What are the best ways, in your opinion, to play the manufacturing upturn, which we are all talking about, which we are getting to hear from companies as well? And this time, broadly, what one is hearing is that this is not driven by very large ticket sort of items like how it was 10 or 15 years ago. This is much more dispersed, much more, smaller orders coming through across a variety of sectors, that perhaps makes it more durable as well. I wanted your thoughts. Go on.
Yeah, I think we are clearly at the beginning stage of a capital, of a capex upcycle. And yes, and we're not really seeing any large capital commitments coming through, but yeah, a whole bunch of capex that is happening in the process industry, like chemicals and so on. And I think the best way to play that would be through some of the engineering kind of stocks, or the capital goods stocks. The thing is, there are not that many large liquid names or the options that are available for typical global investors, and that's why you see some of these stocks have got re-rated to some extent, and that is creating some question marks that whether it's the right time to add here. But I would say that just like how we saw over the last 10 years, the consumer stocks got re-rated from 20 times to 30 to 50 to 70. I think a story somewhat similar to that will be played out in these capital goods and engineering companies stocks as well.
Okay, that's interesting. I want to it's an allied question. You also at the conference have 3 Adani Group companies presenting. And that group is largely seen, and the various businesses they run is largely seen as a proxy for investment. I mean, manufacturing, etc. Is there a lot of interest around that group? What would you like to hear? What are the questions which you will be asking of the managements there from the group?
Yeah, so as I mentioned, there is definitely interest on the capex cycle theme, investment theme, and there are not that many large liquid options, because some of the large names have also got some issues, especially from the European funds that closely watch the ESG factors and especially the defense related involvement as well. So we are clearly seeing investors scouting around for more ideas, especially the large liquid stock names. And and that's the reason why the investors are willing to experiment and trying to kind of look at some of the new ideas that are coming through. And yes, we are seeing a reasonably broad based interest in those stock ideas.
Okay, got it. We've not, Mahesh, spoken about banks and financial services, and you got a plethora of companies presenting there as well. So what are the best ideas from that space? I saw some of the smaller housing finance companies, very high growth, 30-40% growth, housing finance companies like Aptors, Home First, etc., which are going to be there. Where exactly will bulk of the money be made from here in the financial space?
So in the financial space in general, so we quite like the banking story for sure. And I think, given the fact that IT and banks are two of the largest sectors from the Indian market, both of them add up to roughly 55 to 60%, of the index benchmark. So it's very critical that you get that IT versus banks call right. And our clear view is that we definitely have a preference for banks financials, over IT. If you get that one call right, then a large part of your portfolio outperformance can be kind of so it'll be a big driver for your India portfolio performances. Now within banks, I mean obviously there are several large sort of banks, and they're trading at reasonable valuations as well. But what history has shown us is that in periods of stable interest rate environments, stable to declining interest rate environments, NBFCs tend to do much better than the banks. So we have a bigger overweight on NBFCs than on the banks.
IT is still staying away? I mean, waiting for that recession at some point in the future? Waiting for the shoe to drop in that sense?
Yeah, I would say so, because we have seen some disappointments coming through in the March quarter. My sense is that there could be some more disappointments will likely come through in the subsequent quarters as well. And the mid cap names in that space have done pretty well in the March quarter results. Some of the large caps have had issues. But I think if large caps have had issues, it's only a matter of time before that shows up in the mid cap companies as well.
Well, remember, you can catch this full conversation at 5:30 p.m. today, only on CNBC-TV18. So make sure you don't miss that. Well, just take a look at the markets. Rima as well as Surbi are talking about a quiet market.